everyone, and Happy New Year. You're welcome to this week's Business and Investment Tips Program, a production of RCCG Christ Church Radio with Ayodeji Ebo, an investment professional. This week, the focus is on understanding some major changes in the Finance Bill 2022 and its implications. The National Assembly passed the proposed Finance Bill 2022 last week, 29th December 2022, but is awaiting the President's assent. The Finance Bill is expected to take effect on the 1st of January 2023. This is laudable as the government has enacted the Finance Act for the fourth consecutive year. The Finance Bill is the headline fiscal budgetary legislation made annually, which allows the government to adjust taxes, duties, exemptions, and reliefs to support the budget. This bill is anchored on 5 fundamental policy drivers. 1. Tax equity. 2. Climate change. 3. Job creation / economic growth. 4. Tax incentive reforms and revenue generation or tax administration. Some of the major changes we would focus on include 1. Taxation of digital assets. Gains on digital assets, including cryptocurrency, will be subject to tax under Capital Gains Tax Act at 10%. This will translate into increased costs of services, however, improved revenue for the government. A digital asset is anything that is stored digitally and uniquely identifiable that organizations can use to realize value. Examples of digital assets include documents, audio, video, logos, slide presentations, spreadsheets, and websites. 2. Taxation of gaming and gambling companies. Income derived by a company from gaming, gambling, betting, or lottery business will be subject to tax under the Company Income Tax Act. Companies Income Tax, CIT, is a tax on the profits of registered companies in Nigeria. The CIT is currently charged at the rate of 30% for companies with more than 100 million naira turnover and 20% for companies with a turnover between 25 million naira and 100 million naira. The industry is estimated to generate 730 billion naira annually, translating to increase of revenue for the government. 3. Import levy. In addition to existing custom duties and other charges, a levy of 0.5% will be imposed on goods imported into Nigeria from outside Africa. This duty will be used to make payments for Nigeria's capital contributions, subscriptions, and other financial obligations to multilateral institutions like the African Union, the African Development Bank, and the United Nations. This will increase the cost of imported goods and purchasing power, as we will still import more from countries outside Africa due to standardization. 4. Goods liable to excise duty. All services, including but not limited to telecommunication services, provided in Nigeria will be subject to excise duties at rates to be specified via the presidential order. This would increase the cost of doing business as service providers will pass the cost to their customers. 5. Amendment of revenue sharing for electronic money transfer. The Act amended the sharing formula for revenue from electronic money transfer from the current 15% for federal government and 85% for states to 15% for federal governments, 50% for states, and 35% for local governments. This implies that the local governments will have more direct revenue to execute projects. 6. Remittance of value-added tax, VAT, by specific entities. Entities like telecommunication companies, MTNN, and oil and gas companies appointed to deduct VAT at source on invoices received from their vendors will be expected to remit such VAT to the Federal Inland Revenue Service on or before the 14th day of the following month, currently 21st day of the following month. This is to give early access to the VAT collected on behalf of the government. 7. Premium on life insurance. This relates to any amount paid as premium by an individual during the preceding year of assessment in respect of own life or life of a spouse, or contract for a deferred annuity will be tax deductible provided that any portion of the deferred annuity withdrawn within 5 years of paying the premium will be taxed at the point of withdrawal. 8. Repeal of Rural Investment Allowance. The Rural Investment Allowance, ranging from 15% to 100% of the cost incurred by a company to provide facilities such as electricity, water, and tarred roads, where such facilities have not been provided by the government within 20 kilometers of the location has been repealed. This would discourage the provision of such amenities by private companies and lead to more hardship in rural areas, as these amenities go a long way in supporting the populace. 9. Investment allowance. The existing investment allowance of 10% applicable on qualifying expenditure incurred on plant and equipment will no longer apply as from December 31st, 2022. 10. Rollover relief on shares and stocks. Investors need to note that they would require to pay a tax of 10% on the gains they make from the sale of their shares in startups and other companies. This bill, however, proposes that investors that purchase shares from startups will be eligible to rollover reliefs in the event that they reinvest the proceeds of the sale of such shares. Rollover relief provides a mechanism for deferring payments of tax from the sale of an asset, where the proceeds from such sale are reinvested in buying new assets. This would encourage investments in startups. The Securities and Exchange Commission (SEC) recently approved the listing rules for Technology Board, which will allow startups to list on the Nigerian exchange NGX. Thank you for listening. Please join us same time next week for another exciting and insightful session. For comments and feedback, kindly forward to ebo.ayodeji@gmail.com or send an SMS to 07082463747. Stay blessed.